So I'm glad you came, guys. I'm glad you didn't drop. Don't, okay? No, just work hard. Just work hard. I think you guys are all doing well. Most likely. Okay, anyway. Let's do equity. Do you guys know this? We did assets, we did liabilities, and now we're doing equity. That's it. Two types of equity. What are they, guys? Actually, there's three, but what are the two main ones? Contributed capital and retained earnings. And so we're messing with this stuff, right? What's the other one, by the way? It's sort of in between there. Other comprehensive income. Remember that? Accumulated other comprehensive income. We read it about a little bit. That's for later classes. We're doing these two. Okay? So that's it. So it's owners investing in the business, right? That's the contributed capital. Okay? And by the way, we can issue the stock to them, right? And then we can buy it back. We go out to the stock market and buy our own stock if we want. General Motors can buy their own stock in the stock market, no problem. We're going to call that treasury stock, okay? And then they might retire it or might give it to people as stock bonuses, right? Or give it to their employees, officers as stock bonuses. Might give it to the other employees as stock bonuses. They might buy back that treasury stock to get rid of a shareholder they hate. I'm not kidding. Management can't stand them. They're driving them crazy. They give them a bunch of money. If somebody's trying to do a hostile takeover of your company, they'll start buying up the stock. The board of directors might vote to buy them out, give them a whole bunch of money called green mail. We'll learn about this stuff later in finance, right? Buy them off. Whose money are you giving them? The shareholders, right? So management of the company is giving other shareholders money to somebody who's trying to take over the company to prevent them from taking it over. Might the other shareholders be better off if these people trying to take it over do take it over? Or buy them out for a really high price, right? Yeah, they might be. So this is a real interesting ethical area, right? Kind of fun. Fun and, yeah, big deal. Anyway, so we're going to handle treasury stock, big deal. And then, by the way, you have on the retained earnings, what do? We put the net income into the retained earnings, right, guys? Or the net loss. You guys know how to do that already. We also pay dividends, right? So we get a little more sophisticated with dividends here. This isn't too bad a chapter, really. We're going to get a little more sophisticated with dividends. We'll do cash dividends, right? And we'll do the journal entry for that. And then there's something called stock dividends. If I don't have enough money to pay my shareholders a cash dividend, I don't have the cash. I can still give them a stock dividend. I give them a few shares of stock. What have I really given them? Nothing. You own 10% of the company, now there's a stock dividend, they give you 10% of the stock dividend, right? You still own 10% of the company. The company only makes so much income. So how could you benefit from that? Well, a lot of companies pay a standard dividend every quarter or once a year or whatever. So let's say I'm paying a quarterly dividend of $1, right, per share. I'll probably keep doing the quarterly dividend of $1 per share, even though there are more shares now with the stock dividend. So the shareholder might get more dividends. But even that's not a big real value because I don't care if I get dividends or I get growth in the value of the company. Let's say you invest $100,000 or something, and they make $20,000 that year with it. You now have $120,000, right? What if they pay you a dividend of $20,000? You just have $100,000. You're not ahead, right? You just got the money, the dividend, and you have to do what with it? Well, look at my wife, you buy a car. No, but what do? You invest it in something else to keep going forward, right, guys? You guys do know I love my wife, and she doesn't really spend me into bankruptcy. I'm doing okay, right? Yeah. So, although we really do like that. Have you been to that? Oh, what is the name of it now? There's a tapas place over on Hare Lane and Westport Road. You know where that little shopping center thing is? It starts with an A, Altismo or something like that?
Yeah, something like that.
Oh, man. When you are 21, wait till you're 21 because it's wine. Right? Oh, God, they have really great wine. Well, you can still go for tapas. I don't know what it'd be like with water. Yeah, anyway, yeah, so I don't know what food tastes like with water anymore. Yeah. It's like having a pizza with Coke or something, geez. Yeah, anyway, pizza and beer go together. So, how many of you guys are 21? Oh, okay, so try it out. Have you been there yet? That's really good, really good. Kind of a little spendy. I know it's tapas, it's a little tiny bit. Oh, God, it's so good. So we stopped in there last night because went to the optometrist. I saved $250 by keeping my old glasses. Even though they're scratched up and stuff, because all my friends' glasses, you don't need them. I'm so blind now, I can't get blinder, kind of like that. Yeah, so not really. That's not even funny. You can't get blinder, of course. But anyway, so I saved $250, so we had to go give them half of it, right? Just like that. So yeah, that's really good. Really good. So. Work hard, you guys. You'll have money to do stuff. Be good. Sorry. And also money to donate to good causes. Sure you do that. Okay, anyway. So let's do issuing stock. I bet you can do this. Let's say, do this journal entry for me. All right, we contribute, our shareholders contribute land, which is worth $100,000. Building, which is worth $50,000. It's not much of a building, is it? Equipment, which is worth $25,000. Okay, and cash of $10,000. That's what they contribute. Okay.
Is that 25,000?
Yeah, that's a 25. Yeah, sorry. Oh, okay. That was 50, was it? This was 25. Okay, all right. And then let's say they issue common stock that has a par value of $1 per share, and they give them 10,000 shares. Can you do that journal entry? I had to read the chapter, huh? You can do most of it without having read the chapter, right? You might not know what par value is yet if you did. Par and stated value are the same thing. Some states have par values. It's a stipulated value in the articles of incorporation you file. You read about articles of incorporation, setting up your company, right? Okay. So a par value is just a stipulated value, arbitrary. Stated values, in some states they have stated value instead, and the board of directors holds a meeting and they state the value. Got it? And then there are states that have no par, and you just don't have a par value. Okay? That's it. Okay? So you see these different things. What we want, again, and I say this every once in a while, what we want is when you guys read financial statements, you know what you're looking at, right? That's what we're after here. If you're never going to do another accounting class, right? Or you're only going to do 102, right? This is financial accounting, so you can read the financial statements. You know what's going on. It's wonderful. I know it's hard to envision now, but later you're going to be helping run companies. If you can't read financial statements, they'll have to teach you how. Right? And it's annoying for your boss. You're supposed to already know when you get there, right? So hopefully you will, you know, and I know you're working pretty hard trying to get to that point. You don't know you're trying to get to that point. You think you're just trying to survive the class, right? Okay, but really, we're trying to get you to the point where you can do this. Okay, anyway, what's the journal entry? Debit what, credit what, gang? What'd you get? What'd the company get? Land. What do you, it's an asset? You have more? What do you do? Debit land. Even I can do this. What else you want to debit? Building. So we don't care what we got, right? In fact, if I assumed a liability for somebody, I credit the liability, right? I might assume a liability. Yeah, it's part of the deal. I'm buying another business, right? I'm giving them my stock. Got the idea? Okay. What else? Equipment. That was equipment. 25. And what else did the company get? How much is all that total? That's the hard thing. 185. Okay. Now, what am I going to credit, gang? What do I give them? Common stock. Okay, what do you have to know? Common stock is recorded at what? Par or stated value. Everybody got it? Or you learned something today. Big deal. Okay? It's really simple. It's 10,000 shares at a buck. So what's the credit to common stock? 10,000. And guess what the rest of it is? This is a real clever name to this. Paid in capital in excess of par. The paid in capital is how much? 185. How much is in excess of par? 175. Got it? Or you can call it additional paid in capital common stock. Got it? You'll see both of those terms. So now you know what that is. When you look at an equity section for a company, what do you do to figure out how much the shareholders invested in the company? Add together the par or stated value. This could be a stated value. It'll look exactly the same, right? You recorded it stated instead of par value. Okay, the same thing, right? Same entry. Everybody got it? So you have the par value, which is going to be almost nothing, plus the additional paid in capital. Got it? That's all you do. It's not just the par value that's in common stock. And I'm going to actually give you points on a test for doing this, okay? Quiz and test, for knowing how to read an equity section. So anyway, what do we need to do? We need to credit additional paid-in capital on common stock, or paid-in capital in excess of par on common stock, right? Okay? For 175. We're done. Okay? That's how the investment's going to work. All right, what if it's no par? What do you think you'd do? There's no such thing as additional paid-in capital because there's no such thing as being in excess of par because there's no par. So what would you do?
All common stock.
Credit common stock for the whole 185. Done. Got it? So if I say no par, big deal. Huh? All right, so points for this. Okay. Anyway, let's see you know what's going on. All right. Oh, what if it's preferred stock? You read about preferred stock there? Preferred stock isn't really preferred. It is in some ways. They get their dividend first before the common shareholders. That's a preference, right? And in liquidation, if you go bankrupt and you liquidate the company, first you pay all the employees, then you pay the government what you owe them. Pay employees what you owe them, their wages, right? You have to pay that first, okay? Then you have to pay the government all the taxes you owe. Then you have to pay any secured creditors like bondholders. You read about that, right? They have first right, in bankruptcy. Okay, so you pay the secured ones first. Anybody where they have collateral right for their debt, you pay them. Then you pay all the unsecured creditors, so all the liabilities are paid. Got the idea? And then what happens? Preferred shareholders first, and then after they get their money, whatever they get, a liquidation preference, you call it, then what? Anything that's left goes to common shareholders. What usually happens in bankruptcy? There's nothing left for the common shareholders. Who's taking the bigger risk? Common. Who needs to get a bigger expected return? More risk, what do you want? More reward. Yeah, more return. Risk-return trade-offs. You guys know what risk-return is, don't you? Now, it's just that. I take more risk, I get more return. But it's more expected return. Do you necessarily get it? Of course not. You're taking risk. What's risk mean? You could lose your money, right? More risk, more chance of losing your money. But you get paid more for that, right? Okay? If you go get a credit card at the bank, are you independently wealthy? Okay, good. All right. Well, that's fast. No, but anyway, it would be nice if you were. Okay, if you go to the bank and you get a credit card, I go to the bank and get a credit card, mine charges me, I don't know what, go get one, well, let's say 5%. And yours wants what? 18 plus, right? How come? More risk she won't pay than me. It's not really true for us two people, right? But they don't know. Your category doesn't pay, right? If he goes, even though he's wearing a suit, his is 24, right? Yours is 18. Why? Because they discriminate against us males. It's terrible. It's not fair. We need to bring a class action. No. Why? Because males are irresponsible. We don't pay. You're here to find a good woman, right? To support you the rest of your life. Wouldn't that be cool? Yeah. You want to marry him and take care of him for the rest of his life? He's kind of a good-looking guy, right? Now, she wants somebody who's going to make money, too. Yeah, okay. Anyway, yeah. All right. There used to be this joke that women went to school for an MRS degree, right? Mrs. degree. Have you ever heard that? That's years and years ago. Now the guys are going to school to find a woman to take care of them. I know it's true. Yeah. So maybe men have gotten smarter over the years. Okay. Anyway. All right. So let's. So what would you do if this was going to be preferred stock? Guess what you do? I issue preferred stock instead. And it has a par value too, although it's usually $100 or $50. It's not low like common is. Explain why they're real low in a few minutes. But what's the deal here? Change the journal entry. What do you have to change it to if this was preferred stock? Change that name to preferred. You like that? Too easy. And guess what you do here? It's additional paid-in capital on preferred stock. Ta-da. You now know. Okay? So if it says preferred stock, make it preferred stock, okay? Par will usually be $100 a share or something, so the numbers will be different. Okay, good. All right, let's do treasury stock. You want to? I buy back some of that stock, okay? So, the stock is selling out in the market out there. By the way, what was the market value of our stock at the date that we issued it? You guys do that for me? The par is $1, right? What's the market value? What's the market willing to pay for this apparently, the day you issued it? Your shareholders were the market, right? But they bought it. They paid $185,000 for how many shares? That was 10,000, right? What is it per share? You got $185,000 for 10,000 shares. Come on, you guys. What is it per share? $18.50 a share. That's it, right? Okay. Now let's say time goes by. That's it, isn't it? Now let's say time goes by and it's selling for $25 a share, and we decide that we hate some shareholder or something and we want to get rid of them. So we're going to buy 1,000 shares, okay? So this is going to be treasury stock, right? So this was the original issuance. That's issued stock. Let's buy back some treasury stock, okay? Treasury stock. Let's buy some back. So let's say the market value at that point is $25 per share, so of course we have to pay the $25. And let's say we buy 1,000 shares. Got the idea? Everybody's staying with me, right? I know it's Friday and the sun's shining, but this is an easy chapter, so you want to max these points, right? Okay? So good. You know what I just did? I told you my intermediate students were just really struggling, having a rough time. Oh man, you should have seen what they did with a really tough concept. Weighted average cost of capital, CAPM, you know it's tough, huh? There was a 30 out of 30 on a quiz, or 30 out of 30 on the test. And there were a bunch of 20s out of 25 on the quiz. The matcha. Really cool. How did that all of a sudden happen with a group that was struggling? Because they were goofing off and then they started working. Because they want to be CPAs. And I'm telling them, you're never going to be one. I've done that to you, haven't I? You probably will be a CPA because you keep working. Keep working. Keep working. Whatever your degree is going to be. Keep working. Keep working.
They're mean to you, they like you.
They what?
I said if y'all are mean to us, then you like us.
Yeah, it's weird. Yeah, that's true. Yeah.
Just wait till
Well, I'll tell you what, when you go to work, if your boss isn't mean to you, doesn't pressure you, doesn't push you, they think you can't do anything and they're hoping that you leave. If they're giving you all kinds of stuff to do and they're really pressuring you and really pushing you and also kind of encouraging you while they pressure you, push you, they think you've got it. They think you're good. That's a compliment, right? If your professors do the same thing, that's a compliment. I push you guys because I know you can learn this and I know you can do this. I know you've got it, right? You just got to believe that and you've got to put in the time. Put in the time. And that's hard. For all human beings it is. All right, let's buy some treasury stock. This is not an asset, you guys. You bought yourself. Wouldn't that be cool if that was an asset? I'd issue myself $100 million worth of stock, and I would suddenly be worth $100 million, right? Give myself the stock. You know, I could credit common stock and debit account receivable for Keith, right? And I'd be worth $100 million, wouldn't I? Of course not. You don't make money by issuing yourself stock, right? That's why it's equity. So if I buy back my stock, is that an investment? Of course not. You're just reducing the equity, aren't you? Everybody got it? This is going to be an equity account, but it's going to have a debit balance. So what kind of an equity account is it? Contra equity. So here's another one. There aren't very many of these contra accounts, but here's another one. And they all make sense, don't they? Right? I didn't have that much caffeine today, but I'm kind of wired. Oh, I know what it is. The Ducks are playing today. And they're playing Frank Raymond. Anybody had Frank yet?
Yeah.
He went to Holy Cross. He reminded me of that. Isn't that funny? So you're playing my team today. And it's, oh, yeah. And I says, I hope it's a good game. Not too good, but good. So, yeah. Wouldn't that be awful if we lost? I mean, if the Ducks did. It could happen. Has a one ever lost to a 16? But Oregon's good at setting records. I'm nervous, yeah. They are good at setting those guys. How many times have they been in the championship in football and blown it? Yeah, over and over. Gosh. Okay, anyway. Can't win the big games, they say. All right, so what would we do here? How about crediting cash because you're going to give them cash? You bought the stock. How much? $25,000? Sound good? We're not going to debit common stock because we didn't get rid of the common stock. It still exists. It's still out there. Okay? It's still outstanding, we call that. The stock that's out there, cleverly, is called outstanding. It has been issued and is still out there. Okay, we'll get to that in a minute. Okay, what's this $25,000 going to be? Contra account named, contra equity account named what? Treasury stock. Everybody good? Huh? Easy? All right. Let's say now that we decide to sell some of it because we bought it to get rid of the shareholder we don't like. Okay? Whatever. Yeah, a reason you might buy it. By the way, another reason you might buy treasury stock is your stock is selling for a real low price and you think you could send a message to the market that it should be selling for more, so you start buying it yourself. There's a tiny bit of evidence that that sort of works. People will notice it's being traded all of a sudden, you know, so it's kind of sleepy out in the marketplace. You might buy your own stock back. So a little bit of evidence in research that that kind of works, okay? But definitely you can get rid of shareholders by buying it though, right? Okay, anyway, so you've got this stock now, and let's say that we sell 600 of the shares. So let's sell 600 shares. But by then, the market value is $30 per share. Got the idea? Because the market price is changing all the time. Everybody got the idea what we're doing here? So we sell it for cash. So what would that be? Probably debit cash. How much? 600 shares at 30 bucks is how much? 18,000. What do you want to credit treasury stock for? Because we got rid of it, so, you know, we credit it, okay? We don't have it anymore. How much you want to credit it for? What'd you buy it for? $25 a share. So it'd be 25 times 600, wouldn't it? That's what we paid for it. Don't take more out of the account than you put in it. Okay, so what's 25 times 600? Is that 15,000? Oh, what do we call this 3? Okay, this is going to be additional paid-in capital from treasury stock, okay? So I've got additional paid-in capital treasury stock, right? I guess what happened was I want these shareholders so bad that I'll give them stock that cost me 25, right? Okay, I'm sorry, the other way around. They want this stock so bad that even though I only paid 25, right, they'll give me 30 for it. Is that a $5 gain? Well, economically, yes. But do I have gains on doing business with myself? No, so we don't call it a gain. Don't do that. That's tempting, isn't it? You call it a gain. If it was an asset, it'd be a gain, wouldn't it? But this is equity, so it's not a gain. Everybody got the idea? If you get this conceptually, you don't have to remember it, huh? It just makes sense. It's more additional paid-in capital. You know, I had one owner that gave me $18.50 for it, and now I have an owner that gave me $30 for it. Got the idea? Okay? So, all right, good. All right, so then let's say that we decide to sell the other 400. But now the bottom fell out on our stock price, and it's only, they found out that we're frauds or something. No. $16 per share, huh? Bottom just fell out on the market. You know, we had some good products going. We're a drug company, and we had a drug that was going to hit the market and just take off, and then we find out that it's not approved. And, you know, we're in trouble, okay? So our price goes down to 16, okay? And we sell the other 400 because now we need cash, right? Okay, so we're going to issue the 400. What would we get? Cash at how much? 16 times 400, how much is that? 6,400. Not good, huh? What are you going to credit treasury stock for? What's left in treasury stock, you guys? We put 25 in, we took 15 out, there's 10 left, right? Which is $425. Everybody agree with that? See what's going on, right? 400 times 25. Remember when you started this class and when I talk really fast and I talk about numbers, you just go, right, your eyes you glass over, and now what happens? Okay, got it. If you're concentrating right, I got it. That's good. You're developing analytical thought. That's what we're doing here, okay? Right? It's more important than learning the material. Getting so your brain just pops, right? When you hear something, you hang in there, try to grasp it, get the idea right away. That's what you want. When you guys are sitting in business meetings and you're charging people $100 an hour, you don't want to stop. And, you know, until somebody's talking to you who's charging the client $500 an hour, you're charging $100. You don't want to stop them to explain things to you. You do that if you have to, right? But you want to hang in there and think, right, and figure it out. What happens is the $100 an hour people all talk to each other after the meeting. What the hell was he talking about or she talking about? Got it? Okay, so anyway. All right, so what do you want to credit treasury stock for, guys? 400 shares at 25 is 10,000, right? Okay, what do we need to do? Okay, if this was my first time ever I bought treasury stock, what's the balance, and sold some, what's the balance in additional paid-in capital treasury stock? It's 3,000. So how much could I debit that account for? Because I won't have additional paid-in capital anymore. Only the 3, right? Not more. You don't want a debit balance in that account. What would it even mean, right? So what you do is you debit additional paid-in capital on treasury stock for 3,000. Did the journal entry balance? No. So really, I lost a lot of money on this transaction, but I don't call it a loss, right? Because I'm doing business with myself. It's my stock. So what is this going to be? We have to put it someplace. It was 600, didn't it? We have to put it someplace. And where we go is retained earnings. We took some of our retained earnings and gave it to this new shareholder. That's the way you could think about it. Okay? That's it. Retained earnings. And we're done with treasury stock. Told you this chapter's not too bad. But read it, right? Obviously. And practice a little bit. Do some problems. And you'll just nail this stuff. Okay? It'll be easy. Everybody good? Let's do dividends. Do some cash dividends. They're easier. You're going to have to remind me next time because it's all the way to Monday and I'll never remember where we were, what we stopped at. But let's do a cash dividend. And maybe stock dividends next time. We'll see how far we get. Okay. Okay, let's do cash dividends. What have we done when we did cash dividends so far? You know, I pay a cash dividend. We always pay a dividend. Let's say I pay a $100,000 cash dividend. What did we pay it with? Cash. So, and you're taking some of your net income and paying it, right? So you're taking it out of where? Retained earnings, right? So you credit cash and you debit dividends, which is a temporary retained earnings account, contra retained earnings account, debit dividends, or debit retained earnings directly, right? Because that temporary dividends account, that temporary equity account is going to be closed where? To retained earnings anyway, right? So it's really debit retained earnings and credit cash. We're still going to do that, but now we have 3 different dates we're going to mess with, okay? So this is going to be simple. We've got 3 different dates. What are they? One of them is date of declaration. Okay? Another one is date of record. Another one is date of payment. By the way, those could all be the same day. Let's say I'm the only shareholder and I decide I vote to pay myself a dividend. Could I decide to pay myself a dividend and give myself the dividend the same day? Of course, right? That's when I would debit retained earnings and credit cash, huh? It's all the same day. But let's say I am GE. I have millions of shareholders. What do you think? Might it be better to separate the date I declare the dividend, decide to do it, right? The board declares a dividend, right? Board of directors. Have that be one day, and then have another day when I find out who owns the stock. That's what the date of record's for. Who am I going to write the check to? Because, you know, I don't know who they are at any particular moment, right? Okay, with computers it's better, but when you're doing this by hand, it was really something. But it's still bad, right? People are buying and selling the stock all the time. You got to find out who's got the stock. So you have a date of record, okay? And whoever owns the stock on that day is going to get the check. That makes sense? And then you'll have a date of payment. So it'll be different dates. So maybe this is done March 1st, this is March 15th, and this is March 31st. Got the idea? Now this is kind of a cool thing. You need to know about this. There's something called ex-dividend. It means without the dividend. Ex-dividend. When you look in the Wall Street Journal or at Yahoo Finance Online or wherever, right? When next to the stock's name, it'll say ex-dividend if you don't get the dividend. What does that mean? It means they declared one, but you're buying the stock after the date of record. Who's going to get the dividend? The person you're buying the stock from. So you should pay less for the stock, right? So you need to realize whether or not you're getting the dividend. Got it? That's all. That's what ex-dividend is. So that's useful to know, don't you think? You're buying a stock. I don't want the stock ex-dividend. I'd like to have the dividend, wouldn't you? But I'll just pay less for it by the time of the dividend. Got the idea? Okay? So anyway, or if it's before the dividend date, before the date of record, of course, you're going to get the dividend, so you'll pay more for the stock because you're going to get that dividend. Huh? Okay? It's cash. All right. So let's say the dividend is $100,000. And it could be either be a preferred stock dividend, preferred cash dividend on preferred stock, or it could be a cash dividend on common stock. And if you want, you can put a name on it, common stock dividend, right? Common stock cash dividend if you want, preferred stock cash dividend. You got the idea? Okay, so you can name it however you want. If I have both preferred stock and common stock, I probably would do that, don't you suppose? Okay, is the idea? Okay, so let's do the 100,000. What would you do on the date of declaration? I declared it, I now owe the shareholders that money. So what do you want to do if you owe them money? Credit a what? Dividends payable. You got it. Read the chapter. Good job. Make a dividends payable, huh? $100,000. Credit. Of course, you owe it to them, right? And debit what for the 100,000? I just locked up some of my retained earnings, didn't I? Right? I'm going to issue that dividend, that cash to them. Okay? So you could debit retained earnings. Or if you want to, you can use an account, which the author does, that's a temporary retained earnings account, temporary equity account, right? Named cash dividend, right? Cash dividend, common stock, cash dividend, whatever you want to do, okay? So you can use that name instead of retained earnings. And then when you close your books, right, to start the new year, you close that to retained earnings. Everybody got it? It's easy? Not a big deal. What would you do on the date of record, of course? Seeing as you didn't declare a dividend, and you didn't pay anything out, you just found out who you're going to write the checks to, what would you do? No entry, and all you have to do is write down no entry. On the practice quiz, I have problems just like this, okay? And they do in the book too, okay? So crank through those. You guys have figured that out now, huh? Then what would you do on the date of payment, of course? Pay it. And what would you do? Probably credit cash for the 100,000, don't you think? And debit what? Dividends payable. Just like any other liability, we don't care. And that's a current liability because obviously we're going to pay it within a year. It's current, huh? Everybody got it? This is easy, huh? Good, good, good. So now we're done with cash dividends. All right, let's see. Let's do this. Authorized issued and outstanding. Okay, and we're going to use this for stock dividends. Oh, there's something called a stock split too. Stock dividends, you give people shares of stock. The stock split is you split the stock. So if I had 100,000 shares and I split it 2 to 1, I now have 200,000 shares. 10 to 1, I now have 1,000,000 shares. 100,000, 10 times. Got the idea? The reason we do that is because over time, as our company becomes more valuable, our shares of stock become more and more expensive each, right? So let's say you issued the stock in the first place for $10, and now it's worth $1,000 years later. How many people have $1,000 to buy one share? Got the idea? Plus, people like to buy a lot of shares. They'd rather buy 1,000 shares for $1 a share than buy one share for $1,000. Somehow it makes you feel better or something. I don't know. But they're easier to trade, of course, right? Because if somebody has $500, they'd have to buy half a share, wouldn't they? So what we do is we keep splitting it. When you split the shares, though, do you have any more wealth in the company? No, you just have more shares, right? There's no more equity. So what you do is, if I do a 10 to 1 split, I have 10 times as many shares, but I make the par value be 1/10 as much. So the total equity doesn't change. The contributed capital doesn't change, right? The company's not worth anything. What do you think will happen to the market value if you do a 10 for 1 split? Let's say it's selling for $1,000 a share now, and you do a 10 for 1 split. What's it probably going to be selling for now? $100, right? It's going to go down, isn't it, dramatically? But you did that. Does that make sense, guys? But usually you won't wait till it gets to 1,000. If we got to 100, you do a 10 to 1 split, get it down to $10. Then when it gets to 100 again, you do a 10 to 1 split again. Got the idea? So what if General Motors had never split? What if GE had never split? Imagine, right? How much those shares would cost each. What if Microsoft had never split? If Apple had never split? Thousands and thousands, right? Dollars a share. Microsoft, the original shareholders, would have never split. Might be millions of dollars a share, right? Okay, so we would be able to buy shares. So what you'll see is par values of a penny or 1/10 of a penny, right? How does that happen? They issued the stock the first time with $1 par. Keep splitting it and splitting it and splitting it. Gets smaller and smaller and smaller. So it was going to look really funny in the financial statements, huh? But now you know what you're looking at, huh? Okay, we'll do some more on that. All right, what does authorized mean? I do an articles of incorporation for the company, right? Set up the company. and I ask the state, by the way, when you file articles of incorporation, you're asking the state if you can do business in their state. You know, generate economic activity, pay taxes, provide jobs. How many states say, no, we'd rather you didn't do that? Not very many. How about if you, though, have a felony conviction for embezzlement? They'll say, no, you can't do that, right? That's going to be the only time, of course. Or you want to, you know, you'd really like to be a heroin dealer and be incorporated. And they probably won't go for that one, right? Okay, so it's got to be legal activity, and you have to not be a fraud. That's okay? Or they think you're not a fraud. All right, anyway, so we might authorize 1 million shares, okay? So let's say we authorize 1 million shares. And then let's do the transaction we just did. We issued how many, was it 10,000 we did? Or no, it was, how many shares did I issue the first time? Was it 100,000? It's 100,000, okay. So I issue 100,000, okay. So that first journal entry we made, we issued 100. Okay, there's another term, unissued. If I have authorized 1 million, I've issued 100 of them, how many have I not issued? 900, that's unissued. I'm going to give you points for that. You like it? This is nice, huh? This is a good chapter. Okay, so yeah, you know, what's authorized, what's issued, what's unissued, got the idea? Okay, now, there's also treasury stock, right guys? So let's say we bought back that 10,000. Or it was only 1,000, wasn't it? Let's say we bought back that 1,000 shares. Got the idea? Now what would you say? How many are authorized? 1 million. How many are issued? Still 100,000. How many are treasury stock? 1,000. How many are outstanding? What outstanding means are the ones that are still out there being traded, right? Out in the marketplace. How many were outstanding as soon as I issued 100,000? We would have said issued and outstanding are 100,000. Got it? What if I buy back 1,000? Now I'd say issued 100,000, outstanding 99. That's it. Got it? This is simple. Which ones are you going to pay dividends on, whether they're cash dividends or common dividends? The outstanding or the issued or the authorized? What are you going to do? If you did authorized, who are you going to write the checks to for the 900,000 that aren't out there? Nobody. To yourself, I guess. Nobody writes checks to themselves, so it's kind of a waste. Okay? It wouldn't make any sense. All right? How about the treasury stock? Who's holding the treasury stock if you have some? You are. You going to write a check to yourself? Of course not. So who are you going to give the dividends to? Only the outstanding. That's it. This is simple. Common sense, right? So if I do a $1 per share dividend, how much is the total dividend going to be? 99,000 bucks, huh? If I do a 10% stock dividend, 10% of what? 10% of the 99,000. Got it? Everybody good? I wouldn't do a stock dividend on the treasury stock, and certainly not for the unissued ones. That make sense? Okay. Now, a stock split's different. I'm going to split them all. Okay, I'll split them all. Everybody good? So let's do a 10-to-1 stock split. Let's do a stock split. Okay? Let's say my par value, let's make it simple, is $10 per share. And let's say the market value right now is $80 per share. And let's decide to do a 5-to-1 stock split. I'd probably do a 10-to-1 there to get it down to $1 a share, or get it down to $8 a share. But let's say it's a 5-to-1. I'm going to do a 5-to-1 split. Stock split. Everybody got the idea? What's going to happen is I am going to give everybody that's holding 1 share 5 shares to take back their 1. Got the idea? That's it, including myself on the treasury. And I guess including myself on the unissued, really. Okay? It's just going to be 5 times as many shares. And the par value is going to go down, par or stated value, either one, is going to go down by what? To 1/5. So the total par is still the same. What's the total par for this company? It's 100,000 times 10, okay? Actually, maybe we should use the dollar that we did before. Let's do that, so you can see it maybe better. Let's use the dollar we have. Let's say this was $1, and now it's selling for 80. So this is $1 a share. Can that happen, by the way? That's what we did, wasn't it? I did $1 a share on 100,000 shares when I issued the stock. I did, didn't I? Okay. So let's say it's $1. Okay, it's $1. Selling for 80. Can that happen? Issue stock to the original shareholders for $1 and it becomes worth 80? Yes. So they're investing for, right? Nice, huh? They made a lot of money. Get the idea? Because the market value is what it's worth, right? Now the par might have been $1 though, and they might have paid what for it? What did these guys pay for it in the example we did? $18.50, right? The $18.50 became 80. You're still pretty happy, aren't you? Right, guys? So now you can look at what's happened with companies. You can look at what the original investment was. That's the paid-in capital. What's paid-in capital? Common stock or preferred stock plus the additional paid-in capital, right? That's what paid-in capital is. Okay, you can look at the paid-in capital and you can look at the market price of the stock and compare them, can't you? You can see what the company's done over time. It's just simple stuff, right? Okay, good. So we've got $1 a share, $80 market value, that's par. $80 for market value per share. We're doing a 5-to-1 split. How many authorized shares will there be? Fill in the schedule for me. Go ahead and do it. Fill in the schedule for me. Every single one of them is going to happen. Everywhere I've got a check mark there, put a number over into the 5-to-1 split. Can you do it? You're going to have 5 times as many shares in each category. Yeah, every single one of them. The authorized will change, the issue will change, the treasury stock will change, therefore the outstanding changes, the par value will change, and I bet the market value changes. Now, we don't know exactly what will happen to the market value, right? Because it's out in the market. The market determines what happens there. But what do you bet if there's 5 times as many shares? The market value will probably be about 1/5 as much. And then changed by whatever would have changed that day, right? You know, because there's other things going on out there in the market. Nice that this is an easy chapter. If the next one's just up there, so is the one after that. But analyze financial statements again. So 2 easy ones, 2 tough ones left. Let's give you a little brain rest here.
How many more quizzes do you have?
2 quizzes, a test, and a final. 360 points. Right?
What about appendix?
Oh, the appendix is just one of the chapters. So the appendix is the next chapter we go investments. It's not really an appendix, you guys. It used to be a chapter, and I think there were a lot of faculty who decided it was just too hard for you principal students to do. So they don't think you need to know about companies investing in other companies. Really? I once worked on the Memorex audit, you know, Memorex tapes, different computer stuff. I worked in the Memorex audit. They had 300 subsidiaries. Subsidiaries are companies that you own. 300. You guys don't need to know about this stuff, right? Every financial statement you're going to look at for a large company is going to say the company name, XYZ company, and subsidiaries, consolidated financial statements. And for some reason they put it in an appendix. Are you kidding me? And then companies also have extra cash around, right? And they invest it for short periods of time called trade securities, for a longer period of time called available for sale short term, more than a few weeks but less than a year, and then also available for sale long term. We already did held maturity bonds. Well, if you don't hold them maturity, they're an investment, right? So we're doing investments in other companies. Got the idea? That's what that chapter is. It's a chapter. So the fact that it says appendix, don't blow it off, okay? It's one of the toughest chapters we're going to do, right? Maybe the toughest. I don't know. Yeah. Is bonds tough? Not after you get it, is it? A lot of people think bonds is real hard. Statement of cash flows, by the way, that other chapter, one problem. I'm going to show you how to do a statement of cash flows, and I'm going to expect you to know how to do it. So when you read one, you're going to know what it is, right? For the rest of your career. It's really cool, right? That's all I'm trying to do with you guys, right? I want you to take this with you, right? Otherwise, why bother? Why do it, right? Okay, so that's what we've got left. And then analyze the financial statements. You'll also do that in Accounting 102 and in Finance 315. So, you know, we'll gloss over that a little bit. So it'll be fun. Because we're going to run out of time. Always do. Okay, how many authorized? How about 5 million, guys? Did you write that down? It is, isn't it? 5 times as many. What's issued then? I get back every share and give them 5 for every one. There's now 500,000 out there, right? Okay. What's treasury stock? 5,000, 5 times as many. What's outstanding? 500 less 5, right? What is that? What's 99 times 5? 495. Got it? 495,000 shares. These are all shares, right? Shares, shares, shares. Okay, what would par have to be? Well, look, we've got 100,000 times $1, right? That was $100,000, wasn't it, in common stock? What do we still want common stock to be? 100,000. So what does this have to be? 1/5 as much, so it's 20 cents per share. Everybody see it? 1/5. What do you think will probably happen? So this is approximately, it's not exactly. What do you think will probably happen to that? 80 bucks. I bet it'll be 1/5. What's that? 16. But I don't trust myself. Okay? $16 per share. Are we good? Everybody happy? All right. Work, 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 please. If you haven't read this chapter yet, how many of you have not read this chapter? That's the other way around. How many have read it? Well, that's pretty good. You guys are survivors, aren't you? Come on, you guys. Read the chapters before I talk about them, right? Be sure and do that for the next chapter. The next chapter, you want to have read it and tried it, okay? And you're going to be really confused. The appendix one, and the same on the cash flow chapter. Be sure you do it before I talk about it. Yes, sir.
When's our quiz?
Next Wednesday, is it?
So are we gonna have a review session Monday or?
Yeah, I got down Monday, March 21st. Is that Monday? We got a review session 3 to 4, but we'll stay however long we do it.
Okay.
And then the quiz is Wednesday, March 23rd. Okay, guys? Keep working. Thanks for showing up. It's gonna pay off. I know you'd rather be here than out in the sunshine.